Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids Resource for a common sense approach to planning with our money, for our finances, with our investments, for our financial and retirement future. He is Ron Corser, CFP and founder of Cornerstone Retirement Partners. Ron, always a pleasure having you on the program.
Well, good morning, Peter, and good morning, everybody listening to today's program. It's the middle of May. I think it's safe to assume that winter is gone. But again, we live in Michigan, so we'll find out in the next couple of weeks. But welcome to today's program. For those of you who have questions or things you want to talk about, remember the number to call is 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and your question, and we'll respond to you just as quickly as we can. But today we're going to talk about something that is probably heavy on a lot of people's minds, and it's a four-letter word. It's called risk, R-I-S-K. And we're going to chat about that in a lot of different ways, because a lot of times people have their own version or definition of risk, and it's always valid. It just depends on, have we narrowed it down as to what kind of risk we're talking about? Because there is all kinds of risk out there, ladies and gentlemen, and we know it. The key is to try to figure out what kind of risk do we have in our life that we can control to some extent, and what kind of risk is out there that we can't control. Why would I bring that up? Because if we focus on the things we can't control, we're not going to be able to control them anyhow, and we're really not going to be able to figure out what direction we want to go.
Might drive us a little crazy.
Yeah, so let's figure out what we can control. And I'm going to go back and tell this little story, because I've told it before, and I know when people have listened to the program and they've called in and we've talked to them, they kind of said, I heard what you did. That's really stupid. And I said, well, I was young then, you got to give me a break. Well, we used to play this game when I lived with my grandparents in Pennsylvania, a little coal mining town about 20 miles northwest of Johnstown, Pennsylvania. And in the wintertime, we would go out in the creeks or on a pond, and we would play a game to see who could go out the farthest without falling in. Now, as I say that to you, I realize that was really a dumb thing to do. But at the time, it seemed like a pretty good idea. And it was exciting because whoever fell in, we'd laugh like crazy at them because they figured, wow, he's really dumb. He fell through the ice. But we played that kind of game. And we did it more than once. And over time, everybody had their little time in the water, so to speak. The really bad part is when you went up to about your waist. Ooh, that was cold. So that's risk. We could control that kind of risk. We just chose not to do it. And the same thing is with us as we think of ourselves as investors. And to be an investor doesn't mean you necessarily have money in the market or you have positions in the market. You can invest in a lot of things. You can invest in paintings. You can invest in land. You can invest in stocks, bonds, mutual funds. You can invest in your children's education. You can invest in your own education. It always is about how much risk are we willing to take? How much of that risk can we control? And what are we hoping to get from that? So stay tuned to today's program. If what I've said already has caught your attention, give us a call, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and information and credit and question in there, and we'll get back to you just as quickly as we can.
Ron, I think a lot of people may feel like being in the market is kind of like edging out on that ice. It's all fun and we feel good until we feel the ice cracking beneath our feet. And a lot of people are worried, is the ice steady right now? Are we getting to the point where we're maybe edging out on some thin ice? Are people reasonably concerned with the stability of the market right now? Do you think that that is a valid worry and concern?
Oh, there's kind of two questions in there. Is it valid? I think it is. I absolutely do. Are they overly concerned? I think it depends on the individual. And what do I mean by that? There's a lot of uncertainty out there all around us, and it develops every day almost. We can sometimes lose our mind if we pay too much attention to it, which is why a lot of us on occasion just shut down the TV and don't listen to the news and just try to focus on things that are a little more pleasant. But I don't think you can underestimate risk. What I think can happen is that sometimes you can focus on it so much that it almost becomes debilitating. It almost freezes us up so that we have a difficult time making any kind of decision. And that's the part where I think today's conversation on the show will help people understand that you don't have to freeze up. You have a choice as to how much outside noise you let into your life and how much of that noise really is based on what we used to call fundamentals in the market and what is just based on either fear mongering or talking heads on TV, talking about the end of the world or things like that.
Well, I know that the news media likes to sort of sell those kind of headlines, Ron. So with the news, it's sort of something to lead ratings, but with me, myself, or with any other investor, it's our life savings that's out there and at risk. Can we afford that kind of possibility of another big market downturn or meltdown?
Well, I don't think anybody can afford a big market downturn. It really gets down to saying, in my life and our investments, so to speak, because we'll just stick with the financial part. There's risk in there. And the question becomes, how much risk do we really have? Because we know ultimately that markets go up, they go down, they go sideways, they go in directions we never thought. When it's going up and we're heavily invested in a market, life is good. Markets are going up, we're making money. And it's interesting that in good markets, people always think they can take on just a little more risk. We really don't know what kind of risk takers we are until there's a correction in a market, either a small one or somewhat of a big one. I'm not talking about a 2008 kind of experience, although that really does kind of bring out what kind of risk takers we are. But if we get a little upset or a little concerned and nervous or worried when the markets go down 5 or 6 or 7% in that normal time, that may be a red flag, so to speak, of saying maybe you don't have an understanding of how much risk you really have, and nobody's helped you kind of quantify that risk. Because in our business, in the financial services world, you can measure risk. What do I mean by that? Sometimes when we talk with people, particularly for the first time when they come in after listening to a program like this, I ask them a question. When the last time you talked to your advisor, what did he tell you about the amount of risk you had in your portfolio? And the answer is, well, he said, not too much. We have a little bit of everything and we don't have too much risk. And my next question, and not to be hurtful about it, is, well, you don't have too much risk. Does that mean in the next correction, you lose 5% of your money or 55% of your money? So one of the things that we do with our firm, and when we come to whether it's existing clients or new people we meet, we try to quantify, put a number, a speed limit sign, if you will, on the amount of risk we're taking. Because we know as investors, if we've been in 401k plans for the last 20 or 30 years, we know that the markets go up, down, sideways, but ultimately they always seem to end up higher looking out over 7 or 8 or 10 years. And I think that's an interesting perspective because it's true. Here's the difficulty. The difficulty comes when you need to start to take money out of your life savings because you've retired or you've had a job change and you need more income, whatever the reason. And all of a sudden the market starts to get wobbly on you and go down. That's a scary situation to be in because all of a sudden now we're taking money out of our life savings. And we're doing it at a time, if it's invested in market-based investments, the markets are going down. So it's almost as if, to use an analogy on the farm, we're drawing water out of a well that's drying up. It just makes it worse. So one of the things about risk is to work with somebody who can actually who can quantify it, who can put a number on it. You know, I work with people and I say all the time, there's something, I'm getting my geek on now, ladies and gentlemen, so pray for me a lot that I don't confuse myself. But there's something called beta, B-E-T-A, which is the statistically derived number that measures risk in the stock market. So the S&P 500 has a beta of 1.0. So if you have a portfolio or an investment that has a beta of 1.5, what a wonderful thing to own when the market's going up. It just goes through the roof and life is good. The problem comes when this thing rolls over. It drops like a rock. So it's important to maybe work with somebody who can provide that information to you. It's like a speed limit sign. The markets have a speed limit sign. You can go 70 miles an hour on the expressway today. It's a reasonably good day. You can go 95 if you want, which means you'll get to wherever you're going sooner. Or you'll meet an employee of the state who hasn't had his donut and he'll bust you for reckless driving. Or maybe the worst thing, you'll have a wreck and not kill yourself, just mess yourself up. Now, if we think about it, this past winter in February, we had 9 inches on the ground and 5 more were coming. To go back to that speed limit analogy, the speed limit on the expressway is still 70 miles an hour. You can try to go 70 miles an hour with 9 inches on the ground and 5 inches coming. You will probably go to the left or the right of the expressway. In that situation, you may be behind an 18-wheeler going 20 miles an hour, praying that he knows where he's going and he can see it. So it's important to measure risk. It's important to understand how that risk could impact your life savings if you're invested in the market. And that's what we're going to talk a little bit about today. So ladies and gentlemen, if this is of interest to you and you have questions, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and question in there and we'll get back to you. And everything we talk about today, ladies and gentlemen, you will not be tested on. So you don't have to worry too much, but take some notes if you're not driving and if you're not sitting in church and go forward and we'll help you.
It won't be tested on until the market goes down, perhaps. You know, it's kind of a real world testing scenario there. The dichotomy that you described, Ron, is interesting to me because I think that's how we're wired with our emotions about our money. The mentality is that we should be beating the market during good times. And he said, you know, if you've got a good beta, man, is that a good thing when the market's going up? But it can be a bad thing if the market's going down. Do you think that it is a normal expectation for investors in general that somehow we are going to be able to meet or beat the market in good times, and then when the market changes direction, not to lose as much as the market during bad times? Is that sort of how we're wired, or the thought process behind what we think should happen when we invest money?
That's a great question. And how I'd respond is that I think we're at a place in our country and economically in this year that the idea of beating the market is something that we used to think about. What do I mean by that? I got in this business in 1994, and in 95 through 2000 was 5 wonderful years in the market. And back then, beating the market was kind of like the mantra. That was the goal, beat the market. So if the market one year went up 37%, you wanted to go up 47. And then the 2000-2002 debacle hit and blew up the market, particularly the NASDAQ. And then we kind of regrouped. Federal government did some interesting things in real estate, and we had another giant bubble in 2007 and 8. And people are still, yeah, I want to do well. I want to do really well. And then the market rolled over on them and hurt a lot of people. I think today what most people that I work with want to do 2 things. They want their investments to grow. They want to have a positive rate of return, and hopefully a rate of return that meets or exceeds their expectations when it comes to inflation. Now, with inflation being where it is, heading for the moon, so to speak, right now, that's becoming a bit different because, if you have 9% inflation, you want to beat inflation, that means you need to get a 10 or 12% annualized rate of return. That's pretty difficult in this environment. So it's changing over time. I think most people just want to have some growth, and they want to make sure that they don't lose it all if the market corrects or goes down. So I think over the last 20 years, these two really bad markets that we experienced have changed people's expectations a little bit. And more, the boomer group is retiring, and they're realizing that, boy, the idea of going for all the gusto and yet exposing my life savings to a big loss just before I retire or right after, that's not something they want to do because they realize they don't have a lot of recovery time here. So I think it's changed over time, Peter, and I think it's changed kind of for the better.
You mentioned, Ron, that it is possible to quantify in the financial world how much market risk we are taking. When you are meeting with an investor and talking about the financial goals, do you then help them to quantify how much risk they should be taking or how much risk is appropriate? Or is there even really any good gauge or rule of thumb to quantify that kind of number?
We can quantify how much risk they're taking in the portfolio. And that's what we do, ladies and gentlemen, the first time you come in, if we start to try to help you, and this is before you join our firm, it's just what we try to do. We try to show people exactly what they own in their portfolios. They could have 6 or 7 mutual funds, but what do you really own? What's inside of those funds? And how much risk do you really have? So we quantify those things as best we can, and then have the discussion of, is this okay? Is it appropriate? Is it right for you? Does it make sense for you? Because ultimately, I think in this day and age, instead of saying I need a positive rate of return, which everybody needs, maybe a better way to express that is saying, what's the least amount of risk I have to take with my life savings in the stock market to get what I need? So those are two really open-ended questions, aren't they? How do we know what's the least amount of risk? And how do I know what I really need? So part of this whole equation, if you will, of trying to figure out how much risk do I have, how much I want to take, is to first ask a really basic question. What is it I want my money to do for me? What do I want it to do? Most people say I want it to grow, and I think that's proper. They may say, well, I would like to have it grow 5%. That may be a reasonable expectation in this kind of a market. But then the question becomes, why do we need it to grow 5% or 2% or 10%? Well, in my life savings, I need some income out of that to supplement Social Security and pension. So the idea of risk, if you start to sense this, is a really important question to get an answer to. But that just forms the basis of saying, what's the least amount of risk I have to take to get what I want? What's the least amount of steps I need to take on that ice before I fall in? I want to take one less step than that. So what's the fewest number of steps? Well, it depends on the thickness of the ice. It depends on how cold it is. It depends on if you're on a creek with running water or you're on a pond. So those are other risk factors that we help people try to understand. But if we can have a nice conversation, we ultimately can get to that point of saying, what's the least amount of risk? What do I mean by that? Let's say you come to me, Peter, and after a nice long conversation, we figure out that you need your life savings to grow 5% after tax, because that generates a number of dollars coming out of your life savings, your IRAs and 401ks for you to live on. And then we say to you, well, you know, we could take this amount of risk, or we can take more risk. Do you want to take more to get your 5, or you want to take the least amount of risk to get your 5, to get what you need? And it's a really important question, because a lot of times people, think, man, I got to get all the market. I need to get more of the market because why? Because down the road, I have to have more money to live on. And my response is that maybe a different way to look at this is say, how do I minimize the potential of downside losses? Because losses are way more plentiful to a person than gains in the market. And think about this. Sometimes people ask, or they make a statement that says, you know, my accounts go down a whole lot faster than they go up when the market corrects. And there's a reason for that. And the reason is arithmetic. Math, M-A-T-H, that's a 4-letter word. So think about it this way. You have $100,000. You take a $25,000 loss or a 25% loss in the market. That's a major correction. So now you have $75,000. What does the market have to do? How much does it have to grow to just get you back to even to that 100,000? You had 100, you lost 25%. Now you have 75,000. Well, the market has to go from 75,000 to 100,000. That's 25,000. 25,000 is 1/3 of 75,000. I'm doing some math here.
Mm-hmm.
So the market has to go up 33% just to get back to even. That's why, in terms of long-term investing, it is much safer in terms of, if I can use that word, it makes more sense to minimize the downside as opposed to go for the gusto to get all the upside. Because there will be losses if you're in the market over long term. Everybody understands that. But if you can minimize the losses, there's a lot less you have to recover to get back to where you were or to have it grow. So ladies and gentlemen, if some of this is making a little sense, I know we did a little math, arithmetic here on the radio, but if you're curious or interested in what's the least amount of risk I have to take in my life savings to get what I want, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, and we'll help you with that question. And we can put some real numbers together that'll give you a great idea as to what you really own, how much risk you really have, and are you on track to achieve your objectives long term? What are those objectives? Number one, I don't want to be 90 years old and run out of money. Number two, if I get sick, I want to have enough money to pay for my bills and to help myself. So those are kind of the key questions that always revolve around successful investing. So give us a call at 616-301-2581, and we will help you.
Kind of continuing the analogy of walking out onto the ice, Ron, it seems like the mentality of investors is that we always need to take one step beyond whatever our goal is. So if we have decided that a 5% rate of return will achieve our goals, we've been trained that therefore we have to shoot for 6 or 7. Whereas what I'm hearing from you is that we're actually more likely to accomplish that goal, maybe if we take one step less out onto that ice. Is that correct?
Yeah, that's absolutely correct. It's always the least amount of risk. It's like if you're going on a vacation, you're going to get on the expressway. The speed limit is 70 miles an hour. Okay, if the expressway had a beta, maybe I talked about that beta. The beta would be 70 miles an hour. So you have a choice. You can drive 95, you can drive 55, depending on the conditions. You get to choose how much risk you want to take in that driving to get to your vacation destination. And the upside is, well, if I drive faster, I'll get there sooner. Or if I drive faster, I could meet an employee of the state, and that will not be a good situation. Or if I drive too fast, I may, end up in a wreck. So it's always up to us as to how much. But isn't the key to get to our vacation destination? That's the real key. So yeah, we can drive a little faster, we can drive a little slower, but the key is to get there on time. So if you're going somewhere and you have to be there 24 hours from now, the key isn't to get there in 18 hours. The key is just to get there safely and soundly in time to check into your hotel room and go do whatever it is you're going to do.
Well, maybe the
So
key is not to drive faster, but to leave earlier. And investing, we want to start as early as possible. It'll help us reach that
that's part of it.
destination.
Or as my stepdad used to say, once we got in the car to travel, we ain't stopping. And we would say, wait a minute, what have we got to go to the bathroom? We ain't stopping. So we'd have to go through the whole tank of gas because we make a stop to get gas. That's when everyone would pile out. And those were not fun trips. Yeah.
As the tank empties, our own personal tank fills up. We got to take care of that.
Yeah.
Well, so we've been talking about this ice and where we head out on that ice. When we come back from the break, Ron, I want to address kind of an essential question. How thin is this ice right now? Do we need to be worried about the market and the volatility and the possibility that maybe we're walking on thin ice with these current market conditions? And then we'll get back to our conversation about the prospect of taking risk with our money. There are upsides, there are downsides and drawbacks. We need to weigh those carefully. We are talking with Ron Corser, CFP, ladies and gentlemen, certified financial planning professional. If you've got questions or concerns, Grand Rapids, you've got a resource. Pick up the phone and give Cornerstone Retirement Partners and Ron Corser a call. 616-301-2581, 616-301-2581, 616-301-2581. They do offer the complimentary forensic financial analysis, a detailed strategy session to talk about your current investment, retirement, and those accounts that will help you achieve your goals into your financial future, those dollars that you're putting to work for you. If you'd like to know how much risk you're taking, the fees that you're paying, the taxes that you may be liable for, how to bring it all together into a structured plan to help you achieve and accomplish your retirement income goals and legacy goals, pick up the phone and give a call, 616-301-2581, 616-301-2581. Quick break. We'll be back with Ron Corser and more on your course to retirement in just a moment. Back here on Your Course to Retirement with Grand Rapids Resource for a common sense approach to planning for our financial, our investment, and our retirement futures. He is Ron Corser, CFP, founder of Cornerstone Retirement Partners. And we are talking about risk today. We're talking about the potential for market volatility, what we need to be doing, thinking about, paying attention to in the market and with our money in order to achieve our important financial goals. Now, Ron, you've sort of given this analogy throughout the program that taking risks is kind of like shuffling out onto a frozen pond or a frozen creek. And at a certain point in time, not knowing when that ice may be thin, when we may crash through, a little bit of a dare kind of game that you played as a child, and hopefully you stayed dry more often than getting wet and cold. But I guess to really round out that analogy and get down to brass tacks here is, I think a lot of Americans and investors are worried that that ice might be pretty thin right now. Where are we? I mean, is there any way to tell how thin the ice is beneath our feet or how thin it's getting?
I don't think we can measure the thinness of the ice except to say, I think we're on thin ice.
Okay.
And most people agree with that. We think about, the Wizard of Oz, lions and tigers and bears, oh my. And that's kind of where we are, aren't we? Inflation and scarcity and chains that are busted and don't work, and we can't get food on the shelf. And you can catastrophize a lot of things, but a lot of it is real. I mean, it's possible, depending on who you listen to, that we could ultimately have a worldwide food shortage. I'm not saying that to scare people, but there's a lot of people that talk about it. We know, for example, that farmers are under a lot of stress. We know that, just reading about it. Now, I don't know anything about being a farmer. Lord, if it helped me, if I ever had to make a living as a farmer, I'd be broken hungry within about 3 weeks. But they work hard and they know a lot about this, but they're paying a lot for fertilizer. They're paying a lot for a lot of other inputs. We have inflation. that, people think, well, we hear that we can tame inflation. Yeah, ultimately we can, but you almost have to hit it with a sledgehammer. For those of us who are a bit aged, I guess, can I use that word? And we went through the last big inflationary process in time in America when Jimmy Carter left the presidency and Ronald Reagan inherited the presidency. We had runaway inflation. How did they fix it? They raised interest rates higher than inflation. Well, that killed inflation in about a year and a half. And also, threw cold water on the stock market. We had a giant recession. So it's a very difficult problem to solve, and it's not going to be solved by excessive spending, which is another thing that people are concerned about. So rather than get too emotionally involved with all the bad stuff, just take a step back and say, these things are going on. I need to be aware of them a little bit. I need to talk with somebody about them and how it may impact my life savings. But the last thing I want to do is panic, put everything in a 3-pound coffee can and bury it in the backyard. Why do I say that? Because when you bury it in the backyard, you may forget where you buried it, and then it's a total loss. So everything has risk to it. And I think that's one of the things I want everybody to kind of hold on to with this program. No matter what decisions we make, everything has risk to it, whether we bury it in a 3-pound coffee can or buy Bitcoin or something like that. There's various degrees of risk. The question becomes, how much risk do we want to take, and do we really understand it? So what are some of the things we can do now as investors which may help minimize the impact of risk on our life savings? Whether you're 30 years old or 65 or 70 years old, what can we do? One of the things we can do, particularly if you're younger and you're still saving, is to get into a systematic saving program. We do this with 401ks, right? Every month, some money comes out of our check and goes into our 401k or 403b, and we buy extra shares of funds. And over time, that seems to work out reasonably well for us. Yes, there are experiences where the market goes down. Yes, there are times we can lose 10 or 12 or 15% in a 401k. But over time, if we keep doing this systematic investing, it makes sense. But what if you're retired and you're no longer having a paycheck and you're doing systematic, you can't do systematic investing? Well, it's really the opposite then. You're doing systematic disinvesting. You're taking money out of your portfolio on a systematic basis. So how you position your assets to produce income in retirement, every month you have to take some out. That's really a critical step into minimizing or managing the amount of risk that's in your life savings. Does that kind of make some sense?
Yeah, and I think that there has been kind of age-old wisdom that says as we get closer to using the money, needing the money, withdrawing the money, Ron, that we take less risk with the money, correct?
Yeah, and the question becomes, what kind of risk is that? So it has been that we have that normal 60-40 portfolio, 60% stocks, 40% bonds. And yet in today's environment with rising interest rates and inflation, bonds are not holding up well at all. So right. What's the option? What do we do then?
Well, I think that is an important point to note and distinction as well, because Ron, during the course of this program, we've really been talking about risk in terms of the stock market, but the bonds are sort of lumped in with the stock market when in actuality, they're kind of a different thing. And in fact, behave differently, correct?
They do. Think about it as a teeter-totter. Generally, the biggest risk in bonds is interest rate risk. So if interest rates go up, inflation goes up, the value of the bond on a secondary market or in our portfolio goes down. It's like a teeter-totter. When interest goes up, the value of the bond goes down. When interest rates come down, the value of the bond goes up. And right now we're in a position where bonds are, they're having a terribly difficult time. So what's the solution? Well, here's a potential solution, is to work with an advisor or look for an advisor who has options that can take the bond portfolio, so to speak, and either use shorter term bonds, if that's possible. And I'm not giving investment advice. I'm just saying, here's some options, or to look for investments that actually eliminate credit risk and inflation risk and can be a great substitute perhaps for that fixed income portion. So a lot of it has to do with asking the right questions to the advisor. Mr. Advisor, I have 30% or 40% of my life savings in bonds, and they're really struggling. What are the options? And it's important to get a good answer from that, and an answer that makes some sense, because there are some options out there that are available to investors. It just depends on the kind of advisory firm you're working for. And we try to do that with our clients. We try to say, okay, there's a lot of things out there that might be appropriate. Let's take a look at some of these. What are some of the options for the bond part of your portfolio, and do they make sense? Is there some downside protection that we can create in your portfolio to give you a little greater sense of stability? And in some ways, we can be a very great help to people. So, ladies and gentlemen, if some of this idea thinking, mulling it through, saying, are there some options to bonds? Are there some options to reducing credit or interest rate risk in the portfolio? There are. Give us a call, 616-301-2581, 616-301-2581, and we can help you explore some of these options. I'm not saying they're all going to be right for you or correct, but wouldn't it be nice to work with somebody that says, we got some other things here that we can look at that might be appropriate for you for a portion of your life savings that give you some downside protection when it comes to interest rate risk, credit risk, those kinds of things. So if that's important, ladies and gentlemen, give us a call, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and question in there, and we'll reach out to you as fast as we can to help you.
Options out there and available, ladies and gentlemen. You just have to evaluate pros and cons, benefits and disadvantages, and find out which option or which options are right for helping you achieve your specific goals. And part of the planning process is clearly defining those goals and then evaluating those options. That's the process there for the initial review, the strategy session, and then the ongoing planning reviews at Cornerstone Retirement Partners. Pick up the phone if you'd like to be in touch and take advantage of the opportunity to go through that strategy session and that planning review process. 616-301-2581, 616-301-2581. Ron, you had sort of a list and agenda for the program today as we talked about risk, as we talked about volatility. Number 8 was the sound approach to volatility. And you've got kind of a list of items there of things that we need to do or consider when we are facing the potential for volatility in the market. The first one, kind of making sure that we just keep a level head. Don't panic, remain calm is kind of important, right?
Yeah. Stay the course and pass the ammunition, so to speak. Be informed. But don't spend 6 hours a day listening to financial TV or things like that.
That can actually lead us the opposite direction. If we're doing that, what I find is because we are so absorbed into the headlines, Ron, we can actually become a little bit more panicked about the situation. Do you find that you've got people who are paying attention to all different sources and as a result, they're maybe
not as many
bit more
clients as I
worried?
used to, because
Okay.
of all the things that are going on. People are starting to sense that, there's something not quite right here. And so sometimes, and I confess that I do it sometimes. Sometimes I'll go home and instead of watching TV, I'll read a book. I know that sounds strange. Or instead of watching news programs, I'll tune into my favorite programs like NCIS and watch a John Wayne movie or something like that, because it gives me the time to escape. There's a limit as to what a human being can deal with effectively and rationally. So sometimes it makes great sense that just don't stay up late and do things. Another thing that people can do, and it's important, is take a look at your portfolio and maybe rebalance it. What does that mean? even in this crazy environment, it's possible to have some securities or positions grow in value. Now, nobody likes to sell a winner, but I always tell people, wait a minute, let's think this through. Why are you investing? To make a profit, right? It's never a bad idea to sell something and take profits. You may hear the tax guys say, well, I tell you, capital gains are going to kill you if you sell that thing. You've had such a big gain. And my response is, would you rather pay a tax on a gain or write off a loss if that stock goes back down? So you can do that kind of thing. You can rebalance, harvest some losses, rebalance your portfolio to give you the best chance to make a profit the next day or next week, next month. Another thing you can do, particularly if you're still working, is make sure you're still investing. Don't stop investing just because the markets are crazy. If you've got a little bit of a long-term horizon, even if the markets are down, you're buying things that are down, that are less valued. And as long as that fund or that stock is still good, you can continue to buy shares. Sometimes you can move to a more preservation kind of mode. What does that mean? Well, in the first quarter of this past year, the market was down almost double digits. At one time, the S&P was down 12.5%. So sometimes you can make a decision of saying, look, we have this downside volatility, we have this going on. I'm going to rebalance my portfolio, make some changes. My advisor is going to help us. If you're with us, we're going to help you to say, how do we protect a little more, but still give us an opportunity to generate a positive rate of return as long as the markets do that on occasion. So it's important to do it, to have some sort of what we call a preservation strategy. Sometimes just staying the course, buy and hold, there's a lot to be said for that if you've got a 30-year horizon. And as long as what you're buying and holding isn't going to collapse, because I always go back to, I was raised in Detroit. General Motors was always going to be there. I ran into clients, new ones, that had General Motors bonds. And when General Motors went bankrupt in 2009, they lost everything. General Motors was never supposed to go bankrupt. It was going to be forever. So things can change. So it's important to make sure that you're not putting all your eggs in one basket, but you understand the companies you're investing in, if you're investing in individual stocks, so that you don't get caught on a downturn, so to speak. So that's something. Don't gamble with money you can't afford to lose. That's pretty common, right? If I ask people, here's your life savings, Peter, how much of this can you afford to lose? Most people say none of it.
Yeah. Yeah.
Then-
Unfortunately, I think it's more common sense and less common. I think that people almost every day probably gamble with money they can't really afford to lose.
That's very true. That's very true. And sometimes my asking the question either frustrates them or makes them kind of rethink what they're doing. But it really is important to know that. How much can you afford to lose? Maybe if I take a flyer on something, I'm not going to bet the farm on it, but maybe I'll take a little piece of my life savings. And I've always wanted to own a particular stock. I don't know what it might be. I've always wanted to own Amazon. I've always wanted to own Tesla. I've always wanted to own something. Why don't we just carve out a little piece of your life savings and put that over here? And that's the really scary, risky part. You can afford to have that go down, but if it goes up, you're going to be ecstatic, but it's not going to impact the rest of your portfolio. So that's one way to deal with some of this. Man, I would like to own that. I wish I'd have bought Amazon when it was $10 a share back in 2009. Well, you can't, at least unless the market goes back down. So those are ways to deal with it. Don't gamble with money you can't afford to lose. But if you want to take a flyer, what we call on some things, carve that out and put that away. So it's not going to impact your basic income on a monthly basis. If it goes bust, it's not going to mean that you have to go to the poorhouse. It's just your kind of fun money. Instead of going to the casino, you're going to put a little bit in the stocks and some of these things and bet on it. That makes great sense. It really does, for a rational approach to investing in the stock market, managing risk in your portfolio.
the probability for payoff may be a little bit better as well. At least you can make some educated decisions on where the probability for payoff may be increased. But again, we're talking about risk. We're talking about volatility. There are no certainties or guarantees. And what looks like a fantastic price today, maybe a discount into the future. What looks like a low price today may seem like a high price in a month or two. You just never know there. And therefore, another one of your rules here, Ron, don't try to time the market. You want to invest as early as often as possible and as much as possible. But when and where a certain stock, a certain company reaches its high or reaches its low, I know they give statistics on the 52-week high, the 52-week low, the all-time high, all-time low. That's kind of all a relative matter if we project out into the future. We don't know with certainty.
Yeah, that timing the market thing is kind of spooky. Yeah, I'm not talking about when you run into a 2008 experience where Lehman Brothers blows up one Sunday on 15 September 2008. That was bad news. Nobody knew anything about that. That's different from saying, you know what, I think it's time to jump in full force in the market and go for the gusto, or I think the market's so high, I'm going to get out of the market. Those two extremes generally do not end well for investors. A much better approach is to say, you know what, I think I have a little too much risk for my own comfort. I'm going to take profits, pull back, and reallocate my investment strategies to some things that don't have as much risk. I think that's a much more rational way to approach it. Sometimes people say, well, I'm just going to get out of the market, put it on cash. You can do that. And if you guess right, and the market goes down 30%, you're going to feel real good. On the other hand, if the market doesn't do that, you're going to miss out on some of the gains. So you really have to sit back and take a more rational approach to saying, I don't want to time the market, but things are going so good now. I'm investing to make a profit. Why don't I take a profit? What's wrong with taking a profit? I don't know. Nobody's ever been able to tell me that other than a tax guy who said, the taxes are going to kill you. You're going to pay tax on that. Yeah, you'll pay a capital gains tax long-term, most likely about mostly 15%.
Well, so important to note, Ron, is that a lot of people are dealing with investments that are in retirement accounts, which wouldn't necessarily generate that capital gains just by realizing a profit.
That's very true. It's absolutely true. So you have a lot more flexibility, so to speak, in what you do or don't do. Most of the time, particularly over the last year, when I've been able to contact clients and said, you know what, we've got this one thing that's made a lot of money. I don't know where the market's going, but I don't have a sense that it's going to continue to go high. How about if we sell it and take profits and reposition that money in something else? If I'm wrong and the market continues to go up and that continues to go up, you can yell at me and beat me with a stick. But if I'm right, we'll have gained some profit without giving it back. And most times people understand that process and they understand that is a kind of a small minor investment strategy. And most people are good with it. They really are. So ladies and gentlemen, if what we're talking about has kind of hit a soft spot with you, or you want to learn more, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and we'll reach out to you and help you with whatever it is you'd like to have help with.
Again, Ron Corser, CFP, here as a resource, ladies and gentlemen, one of the team members from Cornerstone Retirement Partners that do serve as the resource for Grand Rapids area savers and investors and retirement-minded individuals and couples, those proactive planners serious about working and having your money also help you work toward achieving your financial goals. If you would like to take the time and take advantage of the opportunity for that complimentary review, that forensic financial analysis, that strategy session, pick up the phone, give a call, 616-301-2581, 616-301-2581. 81. And Ron, there are options. If we are risk adverse, if we feel like we've made some progress and maybe want to assess the amount of risk we are taking and tone it down, there are options out there that can give us a quality of protection for either our principal or our income generation power that can really serve to help hedge some of the volatility.
There absolutely is, and that's important for everybody to understand. There are ways to, without getting too complicated or goofy or risky, there are ways to hedge the downside of a stock market-based portfolio, and there's ways to hedge just your income. And a lot of times we think about hedging as, well, I just have to hedge my investments. An important hedge to really consider, and maybe from my point of view, my bias, the number one hedge is, how do I hedge and protect the income I need every month coming into my checkbook to pay my bills and maintain my lifestyle? How do I protect that income? So you can do it a couple of ways, right? If you're blessed with a pension, that's nice. Social Security is nice. But perhaps you need to take a portion of your life savings that may be stock market based and put it into an account that will generate income that's predictable, in some fashion guaranteed, that will just keep coming in whether the markets go up or down. The real key to successful investing is to make sure you have protection for your income. Whatever income plan you create, the income that you need coming in every month into your checkbook, you need to have a plan to protect that so that no matter what happens in the market, that's not going to change, because you don't want to be 5 or 6 years in retirement and all of a sudden your investment strategy that was supposed to produce the income isn't doing it anymore. So protecting and hedging the downside of your income plan is most important. And ladies and gentlemen, if this makes sense to you, if you want to make sure that your income plan stays steady and keeps going no matter what happens around you, give us a call, 616-301-2581. 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and we'll help you out, answer your questions, provide the information you need.
I heard a recent conversation that was interesting to me, and it was a conversation in reference to a very famous and famously successful investor, Warren Buffett. And the conversation was pertaining to, well, Warren Buffett says to not own anything that you have to sell in order to create income, because if you've got to sell it in order to create the income, well, then you no longer have the asset. What's your thought or take on that? The example was gold. You could buy gold and it could go up or down in value, but if you wanted to take an income from it, you had to sell it, and then you no longer had the gold. What is your take on that? Because I know a lot of people put a lot of potential value in the protection that something like gold could offer.
Well, I think that's pretty good advice. If you have to sell something to generate the income you need, think about what has caused that. Number one, you've either spent more money than your plan called for, or number two, you placed too much emphasis on the stock market to generate the income you need. And so all of a sudden, for any number of reasons, the dividend got cut, it's not generating enough cash flow, you have to sell the asset. And it's pretty rare that you have to sell an asset in this environment when the market's gone up. It's much more likely that it's happening because something's gone wrong in your plan. So it is a great idea to not try to sell something because you need more income from it. And yes, when it's gone, it's gone. It's not going to generate anything. It's a much better idea to create an income plan that doesn't rely on a particular security or a particular investment strategy that's totally 100 based in the stock market. And so what do I mean by that? You take a look at things that perhaps can generate predictable income over time. I think one of the most rational approaches to take for this, and it's an option that I encourage everybody to at least look at to see if it makes sense, are principal protected annuities. Not the variable annuities, but principal protected ones, because they can be put into your portfolio, into your investment income plan, to give you income that keeps going for as long as you live and that won't change. I mean, it's another source of predictable permanent income that's so important going down the road to make sure you have that so that you don't have to sell something that's underwater just to get income that you need. So that's just one idea that it can maybe help some people. But always remember that the most important thing you can hedge or protect is your income flow on a monthly basis. If you do that, you will have a wonderful retirement plan, as long as you don't start overspending to the point like Peter here might do, getting a vintage Maserati because he's always wanted that.
Always pointing the finger at me and my spending habits, Ron. But a great conversation today. And I think that a lot of savers, a lot of investors, a lot of workers, a lot of retirees are reasonably concerned with the possibility of taking losses, with volatility and with risk. And no one wants to suffer market losses. Unfortunately, that is a natural part of the investment experience. And so considering where we can have some protections or securities, where we can incorporate that into part of our investment experience is part of the planning process that we should be doing, not just one time, but proactively along the way. And as our life changes, as conditions change and evolve, we need to be being extra cautious and paying more attention to that. Now, I think, is one of those times, maybe now more than a lot of times, at least in recent memory, a great chance for us to take a look at the amount of risk that we are taking. And if a 10 or 15% loss, like what we saw at the beginning of the year, if that kind of jitter makes you nervous, it may be an indication that you are taking more risk than is appropriate. And Ron and the team there at Cornerstone Retirement Partners can help you quantify that, can help you better understand that, and can look at those alternatives. So pick up the phone, give a call for that retirement planning review, that strategy session, 616-301-2581, 616-301-2581. Ron, all out of time for today's program, but I know people can continue this conversation with much more specific information on their individual situation by giving Cornerstone Retirement Partners a call and requesting that time for the complimentary review and retirement planning strategy session.
Absolutely. This has been fun talking about this, even though it's kind of be a scary topic on occasion. But ladies and gentlemen, have a blessed Sunday. Drive carefully, and we'll talk to you next week.
Don't be scared. Be prepared. Give Cornerstone Retirement Partners a call, 616-301-2581. They're looking forward to hearing from and helping you.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured